This is a comprehensive proponomics analysis of the Bank of England's December 2025 rate cut, the failure of forecasting, and the strategic outlook for UK property. So, first of all, I'm going to talk about the fragility of the just decision, because they only just got to 5.4 to cut the rate, of course. So, the week concluding December 21st, 2025, marked a seminal moment in UK monetary policy, characterised not by the confidence of a central bank in command of the economic narrative, but by the visible fracturing of consensus within the Monetary Policy Committee, the MPC. Not the first time we've had a 5-4, and indeed we had this year, they had to go to decide a second round vote, which they've never done before, because they were at 4-4-1, because the one wanted to cut rates by 0.5%. But the decision was delivered on a razor-thin 5-4 vote, a margin that signals deep ideological and analytical rifts at the heart of Threadneedle Street. This just decision, right, the precarious nature of this move, arrives against a backdrop of macroeconomic dissonance, where official forecasts have been openly contradicted by reality, particularly within the labour market. So for the property investor and the wider economic observer, the headline rate cut is merely the tip of the iceberg. Beneath the surface lies a complex interplay of failing models, structural inflation persistence, and a real economy that is stalling. So what about the anatomy of the split, this 5-4 vote and the Hawks' dissent? It's the most significant signal that it was 5-4, realistically, arguably more important than the rate cut itself. But this indicates the MPC is operating without a unified theory of the current inflation dynamic. They can't agree, right? So to understand the future trajectory of rates and by extension mortgage pricing, we must understand the arguments of the four members who voted to hold. So why hold at 4%, according to those four people? Their dissent was rooted not in the denial of headline inflation or disinflation, but a deep concern regarding the composition of that disinflation. And I do very much agree with this assessment. So, the persistence of services inflation, the Hawks argued that whilst headline CPI fell to 3.2%, this reduction is largely driven by volatile and external components such as food and energy prices, factors over which the bank has little control. The core battleground for monetary policy is domestic inflation, best proxied by services inflation. At 4.4%, services inflation is more than double the bank's 2% target. But the dissenters posited that cutting rates while services inflation remains elevated risks entrenching expectations of higher prices in the wage setting process. They argue that the last mile of disinflation is the hardest, and premature easing could necessitate a painful reversal, aka rate hikes, later in 2026 if wage settlements do not cool rapidly.